So how do you calculate the return on assets, return on sales, or return on equity for a particular business unit? Let me just go over a couple of issues that sometimes come up. For return on assets, the most challenging element to the calculation is actually identifying the net income and the assets that are associated with the specific business within the company that you want to have as the subject for your project. In other words, tying some sort of a narrow number on net income and a narrow number on assets to the individual business unit that you're examining. Okay, how do you do that? Well, if what you do is you take the proportion of the total company associated with a business unit, take that percentage and apply it both to the net income and to the asset number, what you'll end up with is an estimate which is exactly equivalent to the company average. So instead of going through the pain of actually doing that calculation, don't worry about it. Just use the company average as your estimate of the business unit average. You're invited as well to adjust that number up or down if you believe the individual business unit is doing better or worse than the other units within the company that you're studying. So the most direct way is to just look for the company average and make an adjustment. A second thing that you can do to estimate ROA is to look at operating income, which companies generally have to report by line of business in their 10Ks in the United States and in their financial reports elsewhere in the world. Frequently, you can get a measure of operating income for an individual business unit, but not net income. Of course, you need that net income to calculate ROA. So what do? What I sometimes do when I do my analyses on these topics is I look at the percentage of all operating income that's associated with an individual business unit. So let's say you're looking at a business unit that accounts for 10% of the total operating income of the company, but only 5% of the total assets of the company. Okay? So what you can do is you can take those percentages, 10% and 5%, and apply them to the company number for net income and total assets. So you assign 10% of the total income, total net income of the company to that business unit, and 5% of the total assets for the company to that business unit. You come up with the numbers that are represented by those percentages, do the division of return into assets into return, so you're calculating ROA, and that's your number, your percentage for the business. Okay? So, bottom line here is do your best to estimate the business unit profitability for the company that you're studying. In terms of return on sales, the same principles apply. You're looking at net income and taking it as a percentage of the total sales or revenues of the company. By the way, net income, sometimes it's called net profit, sometimes it's called profit after tax. All of those names are indications of net income and would be appropriate for this calculation. Equity is a little bit tougher. Most companies don't break out their equity by individual business units. So what do you do if you're trying to calculate net income over equity for a particular business unit? Then you absolutely have to use the method of allocation that I described earlier. And let me just go over it briefly again to make sure that it's clear. What you do is you say, okay, I'm looking at a particular line of business. I can find out, let's say, the operating income for that line of business for the 10Ks. You want to isolate the percentage of total operating income that's associated with a business. Let's say, again, it's 10% of the total operating income for the company is associated with this business unit. You go over to the aggregated consolidated statements and you take the company's net income and you assign 10% of it to the business unit that you're studying. And then, looking at the business unit again, look for the percentage of assets that are associated with the business unit that you're interested in. Let's say it's 5%. And then go to the consolidated statement and assign 5% of the equity for the company to that business unit. So you're making this translation from assets to equity when you move from the business unit level to the corporate level. Once you come up with that net income estimate and that equity estimate for the particular business unit, do the division and you have your return on equity calculation.